So this session is personally very close to my heart, and I really want to thank all of you for taking time to come to IvyCap Day and be part of this session, and more than that, to really support the entire startup ecosystem of the country through your investments and also giving your guidance to funds and really taking India to the next level. And I think it's amazing to see how each one of you is actually really making a huge difference to really taking India to the next level. So let me first of all maybe spend about a minute or so, if each one of you would like to talk about what kind of investments are you doing, what opportunities are you seeing, and broadly giving your perspective of where you come from and what you're looking to invest in. So if you can just go through that, Shalabh, you can start.
So IFC is the private sector investment arm of the World Bank Group. India is our largest exposure globally. So ever since we started, we've invested more than close to $40 billion in India across different industries. In the last few years, we have really ramped up our investments in disruptive technologies, VCs, and private equity funds. If I look historically, our key investment sectors used to be infrastructure, financial markets, and manufacturing and agribusiness. And funds business used to be a very small baby in the entire equation. Today, in the last few years, because of the startup revolution in India and the opportunity that we are seeing, the funds business and the VC business has become almost second or third largest in our overall portfolio. So that's the growth opportunity we are seeing, and I look forward to the discussion, Vikram, and thank you for inviting me.
Thank you, Shalabh. Manjari?
So at HDFC Bank, we, of course, we look at AIFs for investments, and we do VCs as well as growth stage funds. We also do direct investment. Actually, our direct investment book is much larger, 3 times the size of our LP book. And we look at early stage startups as well as, there's a slight recent shift. We also look at Series B investments now. And as a bank, of course, we are keenly interested in companies that would in some sense work with the bank. But having said that, we also look at financial investments in early stage and growth stage companies.
Thanks, Manjari.
Thank you, Vikram, and thank you to IvyCap for having me over here and giving me this opportunity. It's a real pleasure to be with you today. To talk about State Bank of India, I don't need to talk. She has already talked that everybody knows, and we are older than RBI, which is a matter of pride for all of us. We, since very beginning, are focused towards twin objectives. First of them, to grow the economy, and that's why the State Bank of India was formed. You'll be surprised to know, Vikram, even you would be surprised that the first investment we did was in 1955. We are still holding on to it. And nowadays we get the dividend which is more than what we had invested at that time. But that's history. So twin objectives at that time, we were mandated, or rather we wanted to create the market infrastructure. So any of the marquee market infrastructure entities you see now, we started from that. So we participated in them, whether it is a clearing corporation, whether it was NSDL recently went for IPO, other places. I can just name them and you will find out that each and every market infrastructure, that was a beginning. And then you know that we are associated with IvyCap from the very first fund. We have tried to partner with you. We have tried to see what we can do with there. And it's not just restricted to investing in a fund for the only purpose of getting the returns, which is of course very welcome for us. But we are looking at creating the kind of ecosystem which is actually prevalent in Western economy, especially US. The domestic capital, unless it comes, and I believe that is one of the topic points which we are having, domestic capital, unless it comes, pools of domestic capital, we will not be able to retain the income earned out of it in India, number one. And number two, the demand of capital is humongous in India right now. So the purpose under which we started in 1955, we scaled it up. 2005, we created a separate entity now, which does only AIFP and some strategic investments. So our purpose is manifold. Purpose is not only to boost the economy of the country, provide capital also, apart from debt, also some equity capital to people who really need it, preferably through funds, reason being they are professionals and they know how to take that, because we may not be having the expertise to take the company to the next level, the revenue multiple or EBITDA, whatever. And you guys are there to do it. So that is our purpose. And we have started partnering with funds like yours, and in repeat funds, wherever we see opportunity, we continue. That's where I think it's a longish answer.
No, thank you so much. We're really blessed with your guidance and support. So thank you so much. And SIDBI is a very similar, support right from a fund one. So if you can also give some, background.
Definitely. So thank you, Vikram, for inviting me, and it's a pleasure to be here. And SIDBI, we are managing the sovereign fund of fund, but before that, since 1995, we are in this business. And we were the first institution to launch a fund of fund from our own balance sheet. And we are providing a whole range of products and services to startups. Like we seeded several fund managers to whom we feel proud today. So similarly, now we have ventured into in a very, very big way for seeding these startups. So we have collaborated with leading incubation centers in the country, and particularly we are working into the area of deep tech and hard technologies, where we are subscribing direct equity to the innovators. And this capital we are deploying more as a patient capital. We are not looking for any definite period, 5-year, 10-year or 8-year to give the return, but we are looking forward to stick with them for 15, 20 years if they can bring the real solution to the technological problems which country is facing today. So that's a corpus which we have dedicated out of our own balance sheet, and we have almost around 125 companies today in our portfolio, and majority of them are working into deep tech area. The second important area where we are working, that is fund of fund we are running, and we are managing the sovereign fund of fund, Government of India, and we are also managing a number of state government fund of funds. So put together roughly around 12,000 crore which we are managing, and these are all revolving funds. So ongoing basis this is available to you, and we are working with more than around 200 AIFs at present, and many of them we have seeded. Almost 50% of the fund managers are the first time fund managers. So we take pride, and I'll be sharing a couple of data how has been the experience in seeding the first time fund managers. And the third aspect which SIDBI is doing is that we have launched our venture debt product. In fact, the idea was that we were observing that many good companies, because of the successive rounds of equity, they were losing, the promoters were losing heavily in terms of their value. So what we came that we are providing a bridge funding to the good startups to protect the value for the promoters as well for the investors in a even small amount to a larger amount, the way you look forward, and particularly to meet your operational expenses. So whole range of products and services directly also, and through fund of fund route also we are serving to the ecosystem. Thank you.
Mike?
Thanks a lot, Vikram, for inviting us out here, and would just like to introduce that I'm probably the only family office LP sitting out here. So one of the reasons why we felt convinced about investing in Ivy is that we have had a history of collaborating with academic institutes to be the first consumer of technology. And over a long history, we've tried to adopt new technologies to innovate, and we understand the innovation cycle. Our first foray into investing, based on our understanding of the innovation cycles, was in the renewable energy sector, but from a debt point of view. But Vikram and his team has been instrumental in getting us to invest in the equity side of the investment in alternate funds for more innovations around the supply chain and energy sector. So that's one sector that we feel as if we would like to contribute to.
No, thank you so much for that background. So I think, and Shalabh, I would want to ask this question to you, and we actually, as IvyCap, we've raised mainly domestic funds, and we've raised 70% of our capital is institutional capital, 20% of our capital is IIT alumni capital, and 10% is now family office, like Mike mentioned, and now we started getting a lot of support from family offices. But I think what I've seen is IFC is actually really working to make real impact on the ground. And I think and I'm a big fan of what IFC does, not just in India but around the world. And I think what you've been doing, supporting funds and really investing to really create the impact, and actually in the process create huge value in the entire ecosystem. How do you evaluate funds? What do you look for?
So first of all, thanks Vikram for the question. Our philosophy is definitely to support domestic fund managers. The global fund managers who have access to capital, we normally stay out. So when we evaluate funds, we evaluate it like we evaluate any other investment on 3 parameters. One is financial and commercial returns like anybody else who does. It has to make commercial sense just as it is for SIDBI or SBI or anyone else. But the second is on IFC role and additionality. That's critical. We were set up by 175 plus shareholders of World Bank Group, and our capital is scarce. So there has to be some value that IFC is adding in that investment. It could be financial additionality, which means we come in as an anchor investor, which helps to crowd in other sources of capital, or it could be non-financial additionality, which could be on the ESG side or impact side or governance side, basically setting standards and bringing in global best practices that provide value to the fund or any other investor. And third is increasingly around impact, and I see Vineet sitting there we've invested in IvyCap several times, and on the impact side, it's more than just box ticking. It's about impact on the ground, something which is intentional. So the fund has an intention of creating an impact. That's important. Some people argue that anything you do in India will create impact just because India is a huge market, but we would like a systematic metrics around calculation of the impact, something which is easily verifiable, maybe even by independent checking, and not something just like greenwashing. There should not be any impact washing. So not beautiful PowerPoint, but nothing on the ground. The impact should be measurable, identifiable, easily verifiable. If it stands on all these 3 pillars, then IFC invest. I think the fourth, which is most also important for our funds, is we have our own direct book also. We invest directly also in companies, in whether it's manufacturing, infrastructure, agribusiness, fintechs, financial. We want to see how does the fund complement our overall philosophy of, just like you said, on growing the economy, helping the economy. Government of India is a key partner in all our deliberations. Every 5 years, we have a country partnership framework, which we agree with the government, with every host country government. These are the areas we'll help because it helps the country. So we want to see how does the fund adds complementarity to what IFC is doing directly. Is it something that, suppose we can't directly reach all the startups, so that's why we do it through the fund. There might be companies which we can't do directly, we don't have the bandwidth, the support staff, etc. So then we do it through the funds and we provide whatever value addition and additionality we can provide to the funds. Thanks.
Oh, that's amazing. That's amazing. So let me come to you, Manjari and Mr. Sani. Actually, both of you come from the banking sector, and I think Manjari, you are from the private bank side, and Mr. Sani is from the public sector side. And I think both of you have seen the evolution. And honestly, I didn't know that SBI started investing in 1955. You know, it's like a very, very interesting fact to know. But you know, from your perspective, Manjari, how have you seen this evolution of the investments in the funds, or you know, banks investing as a fund, or HDFC Bank starting to invest in VC funds or PE funds? So how have you seen the evolution of that happening, let's say, over the last 10 years or so?
So actually I can go, earlier than 10 years, because HDFC Limited, where I used to be before I joined the bank after the merger, HDFC Limited used to be one of the earliest investors in funds. And at that point, I recall our chairman, Mr. Parekh, actually working with the fund managers, like our homegrown funds like True North, which was earlier GW Capital and, India Value Fund. So we also took a small stake in the GP in order to get the fund started. And then, of course, we paid down the stake substantially over the years. So our experience in fund investing has started possibly in 2003, 2004. And before that also, we used to work with an international fund called Battery March. I don't know how many of you all recall that, but we also used to work with Battery March and help them with their investments in India. So of course the entire space has evolved substantially over the last 20 years, and we have seen now, I can say that you can see that VC firms and PE funds, they have come of age. There was a time, of course, that you can say that it was a bit of a curve and a wave, and we have seen the funds through all the highs and lows in the last 20 years. But I would say now fund managers and investors have grown pretty savvy, and investors also have set expectations of what they would want from the fund, whether it is financial returns or supplementary sort or complementary sort of engagements. So as HDFC Bank, from our funds, we look at co-investments in a very serious manner. And of course, to answer your previous question as well, governance, track record, and fund LP quality is what we look at when we typically invest in a fund.
Very interesting. Mr. Sani, actually, yeah, from your perspective as well, because this is very interesting, and SBI, of course, now has invested in quite a few funds. In fact, when we started IvyCap, I think there were about 8 funds, domestic funds in the country, VC funds I'm talking about, and today I'm told that there are about 1,500 SEBI registered funds. So I'm sure, people are coming to you very regularly, and often a number of proposals you are flooded with. So how have you seen this whole journey?
Journey started quite long back, I think in 1990s, and it did not only start we also had a merger just as they had. So when I take stock of our portfolio even today, I see quite a few investments were done by the 5 associate banks, which were merged in 2017. So the journey started quite long
Our
back.
first fund had investment from State Bank of Hyderabad also.
I am aware of that. So therefore, this journey had started long back, and in our own, we were distinct entities taking their own decisions, but this journey started somewhere in 1990s, early 1990s. We started very in small, maybe small amounts were started, and just to gain some kind of a confidence or foothold, because there is no asset class in the financial sector where we are not present, either directly or through subsidiaries or JVs. As of today, as we speak, we have at least one subsidiary, 2 JVs where we are investing, we are the GPs also. But having said that, this journey in real earnest started somewhere in 2005. As I said, this was where we scaled up. There we started looking at this asset class as a real asset class where we can add value to society, number one, and then also generate significant alpha for ourselves. We are listed company, so we have to give returns also. So these 2 things. Now to answer your other question, what we decided, what's the strategy, I can lay it out in the public. We started with funds like yours where we have got a track record, we know, and we look at the same all things. She talked about governance, yes, governance, track record, the stability of the partners and the key personnel, whether they are continuing to stay, and we are good in due diligence, all bankers are. So we know if anything fishy somewhere we see, we will just stay out of it. So all these things we look, and then we started looking at DPI. Why DPI? The reason is because capital is scarce even for banks, and our regulator has put a lot of capital requirement on the banks. So therefore to recycle, and none of my management will be very kind to give me funds just to do it. So we have to generate some kind of a profit. Once I generate the returns or the capital comes back to me, I can very easily redeploy it. So what we did, we scanned the market starting from 2005 onwards, and especially the second phase from 2016 onwards, we are really more aggressive. We found good partners like yourselves, where we can write, and we have written higher checks in the subsequent funds, and then started looking at co-investments. I also remember we did co-investment with you also, and we have been doing.
In fact, I was told that was your first ever co-investment.
Yeah, it was. We were learning at that time. So thanks to you, we could start, and then we have, in fact, after that we have done quite a lot, and we are open to do more. So co-investments are places where we know the company, somewhere we know, somewhere we may not even know. But since we do not have the expertise right now, probably even now, you are the expert. So therefore, once we ride on your knowledge, I can even use the word piggyback, and you are kind enough to do the hard work for us while giving the returns to us. Second thing, it also helps you in being able to write higher checks. So if you have some co-investors, so therefore you can actually take a higher position also. So that helps you. This is the second thing. So three things I will put it like this. The governance remains the first, the DPI or the kind of returns they are generating. And the third thing, what value it creates to economy is very, very important. What value it creates to economy, there was a circular which prohibited us from giving debt, which has now been cleared after a lot of deliberations with both the ministry as well as the Reserve Bank of India. That has been cleared, so equity investments, we don't have a challenge right now, because the domestic pools of capital need to grow. So one data point which I got, about 2 years back, there were only 20% of the funds only relying on domestic capital. As we speak in 2025, it is 39. Part of it could be attributed to the funding winter which is there in the West. But there is a sincere effort, and more organizations, SIDBI of course, they have been the pioneers, and us and HDFC, we all have been doing. So this is more or less what we look, and then case to case basis, what kind of theory or what kind of, the strategy they have, whether it is sector agnostic, deep tech. So we have some allocations across sectors. So those kind of allocations, which sector we are right now underweight or we are overweight. So on that basis, and your answer is actually easy and difficult. Easy because I do it day in and day out, and difficult because there are so many things which you'll look at which cannot be explained in such short period which I have been given.
Sure. No, first of all, I think you're being very humble from a learning perspective. I think you've been on a board from representing State Bank of India, and I think we have actually really learned a lot from your presence on the board and State Bank of India in general in terms of support. And so is from Mr. Satya Prakash Singh as well, because SIDBI is like the big daddy of the entire LP ecosystem in the country, right? So I think SIDBI has probably funded almost every fund that matters in this country. And I think the amount of data you would have in terms of the startup ecosystem in the country, and I think it's mind-boggling. So maybe if you can give your perspective of the evolution of this, because you have seen this from much early and from very small funds to larger funds, and you've seen multiple cycles of returns.
So Vikram, in fact, we have a slightly different role than many other LPs, because we have a responsibility to create a supply chain of fund managers to be funded by other LPs. So that is also a role which we have taken, and we are nicely discharging that. So the first time fund managers, if we'll see, the majority of the first time fund managers, in fact, we have seeded. And we are happy to share that many fund managers to whom we had issued the first check of 5 crore, 2 crore, we are issuing now a check of 250 crore, 300 crore to the same fund manager. And subsequently many LPs are joining hands. So obviously, as you said, that we are having a database of almost for the past 25 to 30 years. So majority of these fund managers, in fact, we have the whole history, that where they have worked as an analyst and a principal, and then they have launched their own fund, and what has been their role there and what kind of performance they have. So of course, the performance parameters, in fact, as shared by others, in fact, those are the parameters which I think every LP looks into a particular fund. But one thing surprisingly, sometimes we feel that the moment you talk about DPI, many fund managers are feeling uncomfortable. So that is one area where I would like to call upon all the fund managers, be comfortable with that. That is one thing which is going to determine your future, right? So that is, the whole lot of database which we have created, and apart from that, we have other responsibilities as well, like gender empowerment. So we have made special provisions for the women-led funds, and we have been incentivizing them by way of giving more fee as a management fee, allocating higher to them. Secondly, those fund managers who are working particularly in tier 2, tier 3 cities or semi-urban areas and promoting the rural economy, there is a weightage for that also. So we have been giving, in fact, we have been considering various parameters taking into, and we have developed a proprietary rating module which encompasses both objective and subjective issues put together. And therefore, everything is very absolutely transparent and absolutely online, you must be knowing. So that's the way, in fact, the fund of fund has worked. And we are today happy, really. In 2016, if I share, that when this fund of fund, Government of India launched, before that we were running that 2,000 crore fund of fund from SIDBI balance sheet. And we could hardly deploy around 1,000 crore out of that. And in 2016, when fund of Government of India came, in first year there was only commitment of 40 crore rupees. There were not many fund managers to whom you can really write a large check. And today if we see that many more, good fund managers are coming, and my compliment to the first time fund managers. In fact, if we see, our experience with the first time fund managers has been very, very encouraging. So definitely now they are in the market, and many more LPs, they are joining them, and I think that's the journey which will continue in the future as well.
So for those of you who don't understand the term DPI, it's a distribution to paid in capital. It's the actual cash received. Once you invest in a fund, the actual cash that comes back. So DPI 2 means if you put in 1 crore in the fund, if you got 2 crore back, that's DPI 2. So I think, and all of the people sitting here is like, for them, the DPI is one of the most important factors when they look at investing in funds. Mayank, I think from a family office perspective, how have you seen this? Because I think, obviously, now I've seen number of family offices now, investing, taking larger bets, supporting from seed stage, going up to much later stage as well. So how has been your journey of investing as a family office?
So I think one big differentiation factor has been that we've been a technological consumer ourselves, and we understand the innovation cycle, and we had great amount of confidence in you with regards to your understanding of the innovation cycle and the risk assessment. The second point being that you are invested, and what we look from any general partner is investment in global clusters of innovation. So you basically are tapped into world-class research along with world-class people to execute, and that at least ensures that whatever you're doing is not just for India but can also be utilized for the world and plugged into the global value chain, which is a sense of comfort that brings to the LP in terms of ensuring that the invested money is into such deep technical moats which have been tested against global competition and benchmarked against global research. And that, I think, is the differentiator that we look for when we are actually considering any investment.
Awesome. I think when we're talking about fund investments and investments in the startup ecosystem, and I think the fact that you talked about, Mr. Sani, about the domestic versus dollar capital. Of course, there is a huge dollar influence in the entire startup ecosystem. And given that, when you talk about dollar, we have to talk about what's happening in the global markets. So how much of what is happening in the geopolitical situation, how much of that do you think is impacting what's happening in India and is going to impact, let's say, in the next few years? Maybe if you can start with that, that'll be great.
So that's a interesting and a tough question, as I'm sure for a lot of the people here also. When I wake up in the morning, the first two things that I do a breaking news on is Trump and AI. And I'm sure that's the same for a lot of people here. And I think the geopolitical issue is a risk and an opportunity. Risk, at least, and this is my personal view, risk is probably temporary. There is probably a window where certain fund managers who are domiciled in the US and want to diversify across countries might be on the fence. I was talking to a number of large fund managers who were going to US and pitching to large organizations there. And they were told informally, and again, don't quote me here, to change the rhetoric around the fund. Not to change anything what they are doing, but just to change the rhetoric. And by rhetoric, I mean using the right buzzwords. So that's the optics side of it. And this is coming from very senior people there. So that's one thing. But I think the opportunity is on, and sadly or fortunately, unfortunately, is that the world it has reinforced the power of investing in the country's security, whether it's defense security, energy security, food security, cyber security, data security, supply chain security, you name it. I think countries have got really, for the first time, even more attuned to security for any future geopolitical risk that may come in the next 20, 30 years. And in that spot, India is in a unique position because it's got a very large domestic market. A lot of its sectors are independent. A lot of them are dependent on supply chain and China issue and all that, and therefore you have to take a sectoral view as to how do you insulate yourself and how do you create guardrails so that you invest in those security mechanisms. I think that's a playbook that will come out in the next several years to come. And then layer on top of that the AI inflection point. During the tea break, I was talking to a number of interesting fund managers. I see Vishal here from Avatar Capital. And the AI application wave is just starting. And there will be lots of those who use the AI as a buzzword just to get funding, but there will be a lot of serious startups who will actually use AI application using the proprietary data that is embedded in industries, embedding it in existing workflows. That's here to stay. That's not going anywhere. And associated with that be the demand for GPUs, tokenization, the power demand, the cooling demand, you name it. So while India may not be in the deep tech of building LLM models at the infrastructure level, the middleware and the application layer will consume a lot of your capital, Vikram.
Very, very interesting. Manjri, how do you see the geopolitical situation impacting what's happening here?
Yeah. We are actually seeing a bit of a reverse globalization happening, which in my personal view, it cannot, as in if it goes on for too long, we'll all be sort of self-sufficient economies in the medium term. But I don't see that happening. It doesn't make economic sense. And maybe, these tensions will escalate in the short term, but I expect it to sort of even out in the medium to long term. So I expect things to get back to the place where they were before last year or before the start of this year. And so, I hear fund managers say that instead of looking at startups that are building in India for the world as they were earlier, they are now looking at startups for building in India for India. And fortunately, since we have such a strong domestic consumption story, this should be able to play out. So barring the US, the rest of the world is still available for supply of our products and solutions. And so for US LPs, it may affect in the short term to medium term. But for the rest of the world, I don't expect there to be too much of an impact of the geopolitical tensions that are currently underway.
Yeah, I have a slightly different take on this. Number one, I am not at all worried about this, at least on the portfolio which we are talking about today, because this is a long-term play. We are not here for a short-term period. This geopolitics, friends will be made, enemies will be made, they will be again reconciled, and every day, as he rightly said, every day morning there is something new which comes, we don't know. But this thing, what has already been touched upon, we have so many things going right for India. First of it was the creation of IITs, which is actually the very purpose we are sitting here. That knowledge I don't think can be replicated anywhere. So the knowledge we already had. Yes, people went to US, it was a very friendly, it is still a very friendly place for working, for creating. Many of our businesses are there, and Indian people are very intelligent. Of course, domestic consumption is there, demographic dividend, all that we can talk about. Indian people are very, very intelligent. What stops any of our startups just to relocate to some friendly country like, say, Dubai, for example, UAE? It does not start. So, the progress which India has made, or rather whatever was made by China in the previous decades, I think this is India's decade, the next decade and this decade. We are the largest, fastest growing economy today, and we will continue to be, irrespective of what kind of geopolitics are there. We have continued to, as a country, we have continued to stand on our own. So these small aberrations, still, after all that, we also grew at 7.8 last Q1. I'm sure 6.5 for this, the term tariffs or whatever 50% is there would have shaved some 40 to 50 basis points of our GDP. But the GST cut has itself clarified that. So I don't think any challenge for our companies over there, if they have the right kind of technology, the right kind of product or solutions, I don't see any impact happening on India, but friends and foes will be made. Things will be there. They may have to change some strategies, some relocation of some probably manufacturing facilities or some data center point, that will have to be done. Otherwise, I don't think. And talking about the capital which he said, just one last thing, those people are too clever. They also see. I have seen that FDI into India increase even after the tariffs. I have actually seen, and this is, I can't take the names, but I have seen people making more investments into India because they are in search for growth and returns, which is available right now in India.
Yeah. No, in fact, it's quite interesting and it's very reassuring what you said. 2008, how many of you remember 2008 crash, right? So I raised my first fund after the crash, $100 million in India. So all domestic capital. And SBI was an investor in that fund as well, and we had Indian institutions. And I think Indian domestic capital was not, or in fact was completely insulated from what was happening in the global markets. And a very similar thing what you said, I think totally agree with you on that. Sir, from your perspective, how do you see it?
Yeah, in geopolitics, nothing is permanent, as everybody said. And as far as the capital is concerned, I am saying, you just see the government of India allocation in recent past. Almost government of India has allocated $15 billion fund for the startup and the technological innovation, and everybody knows here. And my invite to all the young people who are sitting and those who are looking forward to do something good for the nation and launch their own fund, perhaps this is the best time. All sorts of capital is going to be available out of the budget. It's a 15-year loan, it's a 50-year loan, 0% interest rate loan, 1% interest loan, everything provision is being made by government of India, right? And you see the sectoral allocation which is taking place, whether it is AI mission, whether it is space tech, you name any particular sector where government of India has not allocated capital out of budget. And that is available to the nation perhaps. This is the best time to invest in India. This is the best time to manage the capital in India. And another important data which I would like to share with you, the data which we have. If you see the global capital which is flowing here, is said that 20% is the domestic capital, 80% is the global capital which is coming. If you exclude the private equity, and you particularly see the seed stage investment and pre-series A, particularly, in that segment, those funds who are doing, perhaps 60 to 70% capital is coming from the domestic sources. And you see the funds who are raising 4,000 crore capital in a single fund from the domestic sources, there cannot be a better complement to the whole domestic system. And I am telling you that some of the high net worth individuals, one day they contacted me and they wanted that there is a group of 15, 20 people, ultra rich people, and they have never invested into the startup ecosystem and they are looking forward how to put their capital. So can you help us in connecting with the people where we can invest some 5-10 crore rupees into alternate asset? So that's the kind of environment which has emerged in the country right now. And trust me, I hosted them in my office and there were 25 people, 25 persons, all ultra skilled doctors and this kind of people, those who are having ready capital to invest 10 crore rupees at least into the startup ecosystem through the mechanism to a responsible fund manager so that they can contribute to the nation building. So this is the kind of perhaps, the things which are emerging in the nation. So going forward and in all these areas, because we have invested through these incubation centers into deep tech companies, and what we are observing, the kind of new companies which are coming up are just amazing. If they are succeeding in their journey, perhaps the future is definitely of India, as Sahni Saab said, the next decade. I said, I'm pretty sure this is going to take a change. You see, reverse flipping of companies. What is that? That is simply showing the kind of trust which they are having in the economy and the policy system which is evolving in the nation. So going forward, there is no dearth of capital, there is no dearth of talent, ecosystem is well stabilized, government is determined to make India a self-reliant country, and we are sure that together we will do that.
No, it's amazing how the government is so proactively working with the VC funds, with the startups, and of course SIDBI has been at the anchor of the whole thing, and I think it's amazing. I mean, very, very fortunate to be in this time working in the areas where we are working. So, and thank you for all the support to the entire ecosystem. Mayank, from a family office perspective, I think the impact of the geopolitical situation is also in the core businesses of the families, right? So, where the source of the capital comes from for the families, right? So, I mean, depending on what business you're in, there might be an impact if you're in exports, especially in garments or jewelry, if you're exporting to the US. So, how do you see, I mean, that impacting the mindset of the family offices to be investing in this asset class?
So, as the co-panelists have mentioned, the only stable environment is the domestic environment. And the basic thing that almost all the fund will be focused on is resource efficiency for resilience to cater to the domestic economy. And that, I think, if we invest in this transitory period, it is there to stay. It is not going to go away anywhere. So I think there is going to be first principles ways of rethinking how to achieve that. And a lot of work which is being put in that direction would be prioritized, and investments will be going in that direction to kind of ensure that we are able to overtake this hurdle. So that's where I feel as if, a lot of the investments will be refocused.
Actually, I'm being told that my time is over.
Vikram, just a point I want to make. As far as the family officers are concerned, in fact, I was seeing a data. Just 5-6 years back, there were hardly 30 to 40 family offices who were investing into alternate assets. And today there are around 400 family offices who are investing into the alternate assets. So that's the kind of trust and the confidence perhaps this segment has created into the eyes of, and many more new family offices are coming and they are joining this asset class.
No, absolutely. Even though I'm told my time is over, maybe I'll take last 1 minute, because I think something very important as a topic to close this discussion is the exits, right? So I think something which is very, very important, we talked about DPI earlier, which is basically if you don't have exits, you don't get DPI. And maybe very quick 30 seconds each in terms of your view on how the exit situation is.
So we obviously want a strategic portfolio construction based on DPI. Secondaries would play a critical role going forward. IPO market, like in last few years, the IPO market in India has been robust. But if the IPO market rise up, how do you basically get good DPIs, and therefore secondaries play a key role? I think that market is still shallow in India compared to the US and other markets. That needs to be developed, and whatever support government can give in enabling the secondaries market would help. Then you can have strategics and M&As and trade and all of that. But you need continuation funds, you need secondaries so that you're not forced to sell just when the company is at the inflection point. So that's critical.
Manjri?
See, I think of course exits are extremely important, and we typically look at a 1x DPI between 4 to 5 years into the fund. And I think exits, of course, would be a very important consideration for any investor, and even from the fund manager point of view, if you were to ensure exits in a timely and frequent manner, then maybe you're making a very bold statement, but your ultimate destination could actually be the retail investor. And private equity funds would really come of age when we have a much larger audience of investors, including retail participation. And therefore, IPOs, of course, the IPO market in India is booming, and you have strategic investments. But if the fund manager is able to ensure a frequent return of, and as in frequent cash flows, then it would make a broader LP base.
Got it.
Sir, just to add to what my co-panelists have already said, there are a couple of things which the regulator has done. SEBI has allowed these continuation vehicles. There are buybacks which are happening by promoters, the companies which really, this is in addition to IPOs. IPOs are already happening. And the third thing which I have noticed recently, like since we keep on scouting the market, the interest from secondaries players. So at least 2 funds in India have already started, which are only focusing on 2 I know of, maybe. No, I know of 2 already. And there are some foreigners, some based out of probably Singapore and other places, who have already started visiting India. So at least 3 funds I know, 2 domestic and 1 from overseas, which they will specialize in secondaries wherever, but they are looking at some kind of a pooled purchase of assets, and on that basis. So I think that IPO still will remain, because all IPOs, yesterday I saw 3 IPOs closed, all of them were oversubscribed 10 times. So, and that includes QIP, all retail, everywhere you are getting the kind of capital. So I don't think there is any dearth of money right now for IPOs right now, so I don't have any challenge, provided the valuations are right. Secondaries are coming, buybacks are already happening. Then again, purchases by other funds, that Series B will go to some other fund having Series C. So a lot of opportunities are there, but for a LP point of view, exit is extremely important, because we need to have some finality. In order to invest in the subsequent fund, we need to get back our capital. That's where the DPI comes in. So one of the criteria which we also look at very, very closely is the ability of the fund not only to generate a book figure, but also to put cash in our hands. So it's extremely important, but there are various ways, and regulator is seized of it, and they are bringing out new and new means to do that.
Just one thing I would like to add on secondaries is that there are many innovative structures in the market just now, and typically when one thinks of secondaries, one thinks of a big discount, but that is actually not the case anymore. And if you have good companies that you are passing on to the new fund, then you could get a decent valuation and good return for the investors of that.
Totally agree with that.
Obviously, exit is very important, and I think there is a need for a large secondary fund, like the government has facilitated this fund of fund for seeding the fund managers. Now, this is the time I think there should be a larger capital for secondaries, because continuation fund, we have a couple of reservations. In fact, this is not the forum to raise that, but we have been raising at various forums, so they have their own limitations. So that will remain there. So of course, and IPO and other things.
Yeah. Mike, the last words.
Yeah, I think 3 to 5 years is definitely something which, as an exit would be a nice one to have.
Awesome. No, thank you so much. I think this discussion can go on and on. There's so much to discuss, and I think very, very important points that I also learned from all of you. So really appreciate your time, and thank you. Thank you for such a nice audience.